All right, we're going to go ahead and get started talking about grain markets. Yeehaw. You guys will find your way back to your seats. We have a couple up here at the, not a couple, you're not a couple, right? Okay. We have a couple gentlemen up here that working together under the flag of the Redding Huber Ag Consulting Group. You've probably seen them before or know them, but Jake Wiener, who's been doing this a long time in this area in the cash grain markets and works with many of you in the room on a personal level, marketing your grain and helping you build your marketing plans and execute them, more importantly. And then to his right, on the left of him, is Nate Redding. Nate Redding, local Greensburg guy, born and raised, spent some time traveling the world, working for Consolidated Grain and Barge down in New Orleans, Louisiana, running the corn hedge desk and all sorts of export knowledge. Basically, what we'd like to do here for this next hour is present them in a panel format, bounce questions off of them, and hear their opinions. He's got some slides for some content, but this is a forum. You've got questions about grain markets. We've got the guys in the room that have opinions. I didn't say answers. I said opinions. But it's well experienced opinions out of both of these guys. So I'm glad they're here. Appreciate you guys. I'm going to turn it over to them. Do you want me to start by just leading into questions, or do you want me to go with the first slide? How do you want to handle it? Questions. All right. Hang on. Let me make sure and bring you up. Here's your chance. Yeah, you guys have a question. I'll repeat it, and then these guys will take it and run with it. How about that? Whoo boy, all systems working at the moment. Doug was making fun of me earlier because I was like, this bird's nest of rookie broadcasting stuff. He said, don't worry, these guys' combine cabs all look like that anyway. And the planting tractors probably by now. All right, gentlemen, so the first question, just to get the ball rolling, that I have is, what do I do with old crop remaining?
Why do you have any remaining? Next. Microphone.
Can you hear me now? All right. To dig a little deeper, because we knew this question was coming, because we started this earlier. Just want to point out some basics here as far as old crop, to where when the decision he just made, we're going to back it up, okay? Production's set now, guys. Ain't going to change, so get over that. We'll move on. 17, we've lost 200 million, mostly because of acres. More importantly, we lost 185 million demand at the same time. So pretty much a wash. Our exports right now, sales down 45.3%. It's February, meaning we got a long way to go to catch up to last year. Not likely to happen. Ethanol production is behind last year. Stocks are down, or at a 9-year high. Ethanol demand slightly less than last year because of global demand. Overall demand started the year projecting 14.5 billion bushels. We're down to 13.9. That's why he said, why do you have corn on the farm?
No, I think that's the gist of it. That there's always risk that the opinion can change, and it's going to lie in what happens in South American production. Can the Ukraine open corridor continue to operate? There's worry that at the end, I forget when the expiration of the current, what they call regime for that green corridor out of the Ukraine expires. But if Putin pulls the rug there, that could be a problem. We've seen a change in the seasonality of how Ukraine corn ships. Usually they ship 4 to 5 million tons from harvest until they run out of corn. Then it dribbles into very little until the following harvest. because of their limitations of, I mean, they've had ports blown up, their infrastructure's blown up, they've had a heck of a lot of problems. They're still getting 22, 24 million tons out of the country, but they've lost their seasonality completely, and they're just been a steady flow. They got so much going over land, they got so much coming out the port, but in the end, they still have an export quantity, and I think that's where our demand numbers were wrong. Ours, USDA, world in general, we started the year with an assumption that the Ukraine's just not going to be able to operate. We're going to plant the residual supply of the world in the Ukraine. We're going to empty the U.S., empty Brazil, and empty Argentina. What's happened is they've been able to ship a lot more corn. China's still been a presence in the world market. They took 800,000 tons of Ukraine corn this last January. At least. We still haven't seen all the vessel lineups clear the books yet, but Ukraine is doing a lot more business than probably what we planned, and they will until they run out of supply. They had a huge carry-in coming into this year, 9 million ton carry-in. As they push that out the door, things change going into next year, but the old crop scenario now, in a market that has a very, very short time window and limited patience when you get up near the $7 price level, as soon as we feel comfortable that there's enough supply to get into the southern hemisphere corn crop, we could very well pull the rug out from under it. And I think that's the fear when you're looking at the costs the gentleman before us just put up there. Your costs next year are really high. Your risk for next year is really high. You have a tremendous margin opportunity in front of you right now. You have an inverse. The futures market is telling you, get the crap out of your bin. Your bins aren't making you any money anymore. You want to be long, you can do it on paper. Volatility is fairly cheap. You can buy futures back, but get the grain gone. And so I guess it's more of a business management. We don't see the future. We don't know what the markets are going to do one day to the next, but we use a lot of assumptions based on what we see in the balance sheets.
I'm sorry, used to talking out loud. Again, export inspections not keeping pace with neither averages or USDA's forecast. Now, yeah, it's still early. We probably have a window between now and June that we could make it up. So if there's hope, that might be the only way. But our inspections are way, way behind, and that's what concerns me. So that's where we're at. Ethanol, just for another illustration, started the new year. We started off with production slower, stocks higher, demand lower. That's not good for ethanol. Again, it's early. We still have 7 months to go in the marketing year, but got to be careful. Someone asked earlier about the Mississippi River. This came out yesterday. St. Louis, they reduced the drafts yesterday from 11.6 down to 9.6. That's not good for exports. That's not good for basis. That's not good for anything trying to go up and down the river. Again, our projections have dropped in $650 million since we start the new year. They just addressed that. And I hate to say this, but high prices do cure high prices. It's called demand destruction, and that's what we're feeling. I won't go into that. That'll be the next slide.
All right, I'm going to roll to the next question. As it relates, you started to allude to it, and Mr. Ward already said something about it too, but as far as new crop sales, how much should we be sold right now, and do you protect the upside on those sales, and if so, what's the best method to do so?
Our stance on that right now is when we were up around $6, we chucked 30% and just said, look, we got cost to cover. This is a good line in the sand to draw it from. We're wrong, so be it. We got 70% to sell. It's a math problem. Has nothing to do as much with market economics as it does looking at forward balance sheets and saying, if we continue, the natural progression is to increase yield, increase production until the market tells you to stop. Well, we've had positive margins for 3 or 4 years. At some point, the market's going to tell us to stop because we're going to oversupply it. That's how we do things. And so at $6, it's not a tremendous return, but it is a very good historical price. And until we get information that says there's a crop shortage in the Safrinha crop or the second crop Brazil, Argentina corn crop's been discounted for the most part. And then we've already got 17 million tons of Ukraine exports built in for the 23-24 year. That still kicks out a balance sheet that's tight historically, but it's looser than we are now. And you got to remember, if you take ending stocks from this current 1.2 billion kind of line in the sand USDA is drawn and take them up even 150 million tons or million bushels, that is it's not a linear change in your price relationship. Price it goes up in a hockey stick formation when you're rationing, and it comes down the exact same way. And so as soon as we get even an inkling of comfort, the price rail gets pulled out quickly. So we said 30% covers some fertilizer, covers some seed. You got crop insurance payments, things like that going on. We'll start there. Longer term, I'd like to be patient on new crop because we still have 3 different production windows that we have to monitor. We still don't know what China demand's going to be. At $5, it's probably 25 million tons. At $7, it's probably less than 20. They're very price dependent. Currently, there's a lot of rhetoric out of China about excess rice supplies. They're encouraging rice feeding just to get rid of spoiling supplies and to avoid the world market. They just opened up Brazil. They just started taking cargoes out of Brazil, pun intended there, I guess, of new crop corn where they haven't had an open FIDO in history. So if Brazil prices cheaper in the U.S., we know China's a price buyer. They will buy the cheapest price on the world market. The world balance sheet bullish guy would say, I don't care where they buy as long as they continue to buy. But their continuing to buy is going to be dependent on price. So the higher the price, lower the demand, just like you put the graph up there.
Some tidbits from Brazil. It's kind of a mishmash here. Bean harvest, corn harvest, you all read it. Just saw this yesterday. Dr. Cornair said that Brazil could turn out to be the lead exporter of corn. We hold that title currently. So those are, I don't mean to be a Debbie Downer, but we got to be careful, you guys, because like we said, the margins we're sitting on are reasonable, but as his graphic showed prior, there's not a lot of skin on the bones. And to cover costs, I've been telling my guys since August, you buy these high inputs, you sell the corn to cover those costs. And luckily we did. Because some of them did buy that higher input cost, but we sold corn at $6.30. It's now $5.90. Well, do the math. I'm still ahead. South America corn, I'll leave that just for illustrative purposes. Cornair is always below the market. He's consistently below what the trade was thinking. But, just look at current corn production, 125. He's right there with the USDA as of last month. So we don't see, he's not seeing a lot of problems out of Brazil yet as far as the Safrinha crop, which is not planted. I think it's only 8% or something like that. Argentina, he's seeing 39, where USDA's 52. So on the low side, he's definitely much less than the rest of the world. As far as the totals, his current estimate's 176 and USDA is 183. So that's not a tremendous slippage, but nevertheless, the Brazil side and South America side doesn't look that damaging yet.
We can talk about whatever you want to talk about. Corn and beans.
Go ahead.
Go ahead.
So we don't have bean slides up here, but the new crop bean equation's a little more difficult now, right? So Argentina's having a crop problem in beans. If he had that slide up there, I don't know if he's got the equivalent slide, but They're 13 million tons behind where we probably started them at as far as initial production estimates. They're 37 versus a 50-ish total production. That's a big deal in the products. Paraguay is getting better weather. Brazil crop, the guys I know that are down in Brazil right now doing crop tours are coming back saying, look, 153, it could be 156, it could be 157. That's a massive bean crop. They were 118 to 120 last year. So you're added your combined South America minus Argentina plus Brazil is almost 1 billion bushels of extra beans on the world market, and they're going into the fields now. Once again, your major buyer of beans is China. They're a price buyer. If Brazil price is cheaper, they're going to go there. We have seen them prop up the front months of beans here in the last, basically since the first of the year, buying a few Feb-March cargoes. Some of these are Sino-Grain stocking replacements. Sino-Grain will stock U.S. Gulf beans because they store better than Brazil or P&W beans. But that's kind of come and gone, I think. You're got the bean market up 15.20, 15.30. We had a shot at 15.50 a couple times, but go back to the original question, what do I do with old crop beans? I don't know why we got them. You need to consider this a very good opportunity if Brazil comes online with this big, massive crop and starts pricing it into the market. There's a few things helping subdue that for the moment. The Brazilian real has been stronger versus the dollar since the first of the year. So the domestic price in Brazil hasn't encouraged a lot of bean movement. I don't think that can last just by the fact that the U.S. is probably going to raise rates, 2 more times at quarter point each. And Brazil's a third world country. The U.S. dollar is going to remain stronger against the real long term. So that price relationship should change. So I really like just being done with old crop beans. Put a pin in them, 15 and change, great, move on. New crop beans, we sold $14 beans. It went down to about 13.5. For some of the more aggressive customers, we'd do some options around that where we'll put in some long strategy, whether it's a short put or I won't buy option premium that far out. I'll only sell it. But it's one of those things that you don't have to do it. You still got 70% of the beans to move, but it is as much a trade as it is a structural play. So it's get 30% of the beans on. We're 1360 right now, so it's not really that attractive. But if Brazil's big, acres are big for the U.S. We have a 300 balance sheet instead of a 200 balance sheet in the U.S. Prices are $2 overpriced. So it's now kind of darned if I do, darned if I don't. What do we do? So I'm going to remain patient because we continue to find some sort of buoyancy here. You've got a double bottom on charts, which for the technical guy is a buy signal. So if we get it back to 14, though, I think you got to really look at the world and wonder why I don't have some new crop beans priced.
So hopefully my next question is going to lead you. Were you getting ready to add to that? I didn't want to cut you off. You look like you had a big thought. I'm going to add merge a few questions here together. All right, don't let it blow your mind. But we've kind of alluded to these in some way or fashion, all three of them combined. But the question is, this has been a multi-year bull market for all intents and purposes, right? For several years, and prices seem currently elevated compared to where they were. They not seem, but they're compared to where they were over the last decade. So the question is, at what point do we return to a lull of flat prices like we did in 13, 14, and 15 when margins become challenging? And that kind of merges in that next question with input cost structure. How does the coming seasons compare to the previous years, and how tight could this margin landscape get?
That one's going to be a tougher question to answer, simply from the standpoint there's so many moving parts in this market. Production, obviously, that's going to be number one. And that comes with acreage, March 31st. What is those numbers going to look like? I mean, as far as corn right now, the trade's talking 90, 91 million acres of corn. And we hear the word battle. Corn needs to battle soybeans, or we need to battle acres. I disagree. As far as corn's concerned, new crop, we've had 3 subpar years. 3. That's highly unusual for our history. What happens when we get back to average, trend line? What does that do to the picture? Now all of a sudden, we've got a demand base that we've destroyed, and we add additional bushels. That's the risk that keeps me up at night. The bean market, you've got 2 hemispheres and a big demand monster in China. That one's even more difficult. I continue to tell my guys, if you got a profit, there's nothing wrong with locking it in. I don't know what else to tell you. Covering, making a sale and trying to cover it with options. Well, option costs are expensive. You go buy a D's at the money call. You're going to spend 50 cents. Well, 50 cents from 590 is 540, and you are break even with an even basis. If you're going to move it out of the field, you're underwater. Beans you can probably get away with slightly above break even, but not a whole lot. So, did that answer your question? You want to add to that?
Yeah, I'll try. I don't know if I add to it, but you go back to the cost of production thing. It correlates highly with prices. Fertilizer will correlate with corn prices. If corn prices back off, I think fertilizer backs off. We've seen a big back off from fall prepays to current spot price fertilizer. What that means at the retail level, I think, is part of the problem with the monopolistic fertilizer world. Not to get on the wrong soapbox here, but they price fertilizer at wherever they landed in Tampa, ship it up, or New Orleans, ship it up, and they sell it at that price till they run out. And then they run it like a gas station. It's really elementary. If they were to trade it at a market price like most of the world had to operate, we'd see much lower prices right now, I believe, just because natural gas has been cut 2/3, one of the major inputs in producing fertilizer. Fertilizer availability has become much more abundant because the world panicked last year and overbought. And so what does that mean? I don't know. I mean, I think you're going to have an abundant fertilizer supply. I think you can be patient there. Diesel fuel seems to be, I mean, it's not by any means low, but it's not screaming higher right now. Guys on the trading team I work with, we have an energy specialist, and he's kind of the opinion, stay spot on fuel. Don't blow your brains out here. It's going to move, but they don't feel like there's this huge demand push outside what we've seen. You've got the economy kind of on shaky legs, maybe a little bit of reduction just due to high interest rates. That is diesel fuel is a macro component of that, and it may reduce a bit. So maybe some of those costs come down, but ultimately what he said is we produce a lot of corn. The price of corn is going down because until you get it cheap enough that the rest of the world wants to start restocking long-term reserves, that's your support point. Okay, the last time we saw that was, let me think back, like late 2020. Was it right after the August report? China stepped in and they bought 26 million tons of corn. All right, then they bought around 20 every year after, but they took their foot off the gas when corn went from $3.60 to $5, and then from $5 to $7, they said, "Whoa, pump the brakes. We're only going to buy what we need." They're going to use up other reserves, just like the rice story I told a minute ago. So that's your floor on prices going down. We'll take it down to a point where there's an import margin. Today there's an import margin into China of a pretty healthy amount. I would expect them to buy a little corn. They supposedly bought a couple cargoes off P&W this week, but they're not buying a lot yet. They're looking at Brazil. They see good soil moisture in Brazil. They see a new grocery store they haven't shopped at before. They've invested trillions of dollars into Brazil infrastructure. They're going to use it. And so the world trade is going to get more complicated because it's going to be very price dependent. On beans, the biodiesel build-out is very supportive, but if the RIN calculation gets changed away from renewable biodiesel RINs, it gets more favoritism to the electronic vehicles. that soybean oil price, which went from like 27, 30 cents a gallon, or not pound, sorry, to 76, 77 cents a pound, back to 61, 62 right now, spot month. If that goes back to a more historical relationship as far as oil versus meal and the crush relationship, the bean demand, or the bean crush margin, which has been incredibly high, $2.50, goes back to 60, 70 cent. I don't know if we'll run the crush plants as hard. We've ran the living bells off these things, and they're breaking down left and right because they haven't done repair and maintenance. We'll see a lot more shutdowns, which will pull back on demand. So, like you said, there's a lot of moving pieces to think about. After 3 years of a bull market, you can go back to the 70s, the length of the big bull markets. This is the longest lasting one we've had. And the correction is usually at least 2/3 of the move from bottom to top. So in corn, let's use 360 to 750. So what is that? $4, say 260, that's $5 corn. So that's a very elementary way of looking at it, but those are kind of things that history has told us to look for when we crack these bull markets.
As we look out into the 2023 crop, and I notice you've got new crop on the screen naturally, but the acreage battle, let's call it the acreage battle. I posed this question to you guys a couple weeks ago when the January report hit, and I saw the planted wheat acreage was so incredibly high. It was up 3.6 million acres, I believe. And the thought crossed my mind as we look at today's prices as we move forward. We always talk, well, they're going to have to buy acres, quote unquote, buy acres. Well, is it even an influence as we move forward? What will that acreage mix, that wheat acreage planted, do to our corn bean scenario as we move forward? And is that something that as we roll into this January, February, March timeframe, leading up to the March 31st acreage report, is that something that will influence it, or is it already past us, or where does the market see the current availability of acreage for corn and soybeans?
I mean, this is the hardest report for me. I hate it the most. I used to try to mess with it. Now it's better to react, in my opinion. But I think we've had every incentive in the world for the last 3 years to plant as much corn and bean combined row crop acres as we can. And we continue to fall short of that 180 kind of combined pool mark. I've seen some balance sheets where they're using 180.5, 181. I guess gut feel, just say 179 to 179.5 is kind of where I'd want to live. Corn to bean ratio only plays into it for us traders, for you farmers. It's really April, May weather. What kind of work do I have in the ground? What kind of seed do I have bought? What does it feel like? If I can get corn in the ground, I feel like I can yield myself to profit. That tends to drive the end result. What that report says could be totally different than the end result. I do think we'll see a fairly balanced, we're not going to see a lot of corn after corn ground. The cost structure is too high. The yield drag is enough that guys are getting wiser and more long-term in their thinking. But we've heard of seed dealers that we operate farms with in Illinois telling us that they're seeing 20, 25% more corn versus beans from their key clients. So I feel like Iowa, Illinois, if given the window, will plant a big corn number. Will they survey that way is a whole nother question mark. Yeah, I mean, it's not a lie. It's not a truth. It's a guess. It's a, what do you estimate? So how do you round? Don't get me wrong. It's a very useful survey, but to trade, when we're trying to guess within 500,000 acres of a 180 million acre pool, statistically, to think you can be that accurate, you're fooling yourself. So I think right now we should fade for more corn than beans, but we'll have to see what the weather does in the end.
Throughout the corn seasonal, because everybody just loves these charts, we should rally, according to this, last 10 years into the beginning of March. This is what, $7 to, so a 30-cent rally wouldn't be out of the question. And that's probably all in anticipation of what the acreage is going to be and, what the weather's going to be forecast. I can't wait for BAMX to tell us that. Thought that was interesting. This is a chart I love to death because it really tells you what a fine line we walk in the corn market, especially when we're sitting here with $1.2 billion carry in. Now, this number itself is kind of our collective agreement between Nate and I and a few other parties of 14.4. Now, keep in mind, this current year, 13.9. So that's a pretty good bump. Now, just so you know, the biggest year was 14.9. So I sat there last night going, wait a minute, that's almost the midpoint. So we'll call that the average. But even here, now that's not a static number, obviously. You know, if the crop gets bigger, demand gets bigger. If the crop gets smaller, demand gets smaller. That goes to say. But just assuming we have a constant number, both in carry-in and production, here's our trend. Here's what the trade's looking at. Farm futures. That was just one guess. I think the old in pharma, it was like 90.3. So it's running in this average. So if we go back to an average, we got about $1.7 billion carry out. Conversely, if we have the same as we had this year, we're back to a 1.1. You know, so you're talking $5 corn or $8 corn. Be careful what you ask for, because $8 doesn't help anybody. You all have to admit that. That just puts more pressure on the buying side, your landlords. I mean, you know, $6.50, $7. We can live with that for a long time, long as expenses stay right here. You know, making 100 half an acre ain't a bad thing, right? As long as we can clear it, we're happy. We'll keep doing what we're doing. But this thing just is amazing to me, how tight we really are. It won't take a whole lot if we have a weather scare. But it could be fast and furious. And that's why Nate's saying, you know, get 20, 30% on the books, cover those costs that you know that are too damn high, and sit back and watch the season move forward. But that's enough for me.
What this doesn't tell you is how the balance sheets develop. I mean, it's an ebb and flow constantly, right? Price goes down, exports go up, as he said. But if Brazil plants and grows a big safrinha crop, we remove risk premium from the market. And so that move from 180 to 177 to 175 has less of an impact because the world balance sheet is more comfortable coming into this year's crop. I would say it's a pretty well given that we think Ukraine production is going to go down year on year. They've exhausted stocks. They're living on fumes. And so that Black Sea competition we've seen for exports for a year now, basically since Russia invaded in February, while they've exported a lot more than we would originally thought, they're eventually going to struggle because they're running out of supply. If they can't get people in the tractors and grain in the field to get planted, I mean, they still got stuff to be harvested is our understanding. They're going to start to come away from the being a world supplier of reliability until this thing's over. So that'll offset a bit of the Brazil production, but big acres, big Brazil production, the risk premium we got to build into the market on a scare is less than if Brazil production falters. And so as we get to the end of this longer bull market, doesn't mean it can't continue. I think you have to be more cognizant of a May, June, which is typically when we get the first real weather scare and often sets the high in December futures, to be selling into those unknowns. You may not know your yield. You may not know if that makes money for you or not. But you got to start extending those price floors and running your business more like a manufacturing. I got to make so many dollars per unit created as you get to the end of this long-term bull market. So if it offers these opportunities, I think we got to be a little more aggressive. And there's been a lot of bad habits built just from the farmers we've met in the last 3 years, where They don't actively participate in the market until June, July. They get bailed out on some summer rally. And maybe it happens again. I don't know. But the year it doesn't happen, the negative hurts more than missing out on part of the positive.
He said a mouthful with that too. And you know, Doug and I have been we talk to you regularly about input costs, and it is a tough donkey to pin the tail on. Like, I get that. Like you said about the balance sheets, it's constantly moving. Yet we kind of have to get out of our comfort level as we move into a market that, particularly the soybeans. Do you have one of those for soybeans? No, that would have been a good one. But the idea with the soybeans, it's tight. Yet to Nate's point earlier, with what is anticipated in South America, a big supply of soybeans, if not record. Is it record number projected?
Yeah, it's a record by a long shot, I believe.
So again, that's a global market, and we're trying to sell or offset risk, is a better way to say it, on new crop soybeans, and that's going to have its challenges. I don't want to chew up all the time with my questions. What questions do you all have? You got a lot of horsepower sitting at that table that can answer anything that's on your mind right now. Don't be shy. And nothing's a bad question. You heard mine. I took care of all the bad questions. Let me repeat the question. The question was, with the price of puts so high, do you still recommend doing it?
I don't recommend doing puts at these prices. No, I would sell them against a cash sale if you've got a marginable. If you're able to understand margin and put those two pieces together, and no, I have a cash sale at 14. When prices got to 13.50, we sold $13 puts for 56 cents. We're basically making the statement at 12.44. I'll take my chances being long. But if we rally from 14, I get $14 plus the 56 cents in the put I sold. Buying a 56-cent, $13 put gives you a 12.44 floor. That doesn't excite me, especially if I'm not 50% sold yet. So, no, making money on puts is near impossible. So, use it if you buy them now and expect to hold them to harvest. I will use them to deflect risk into big events, especially the March 31st report. We've covered 60-70% of our grain going into that, and just in case you get a big whopper that kills you. You've got something there to start grabbing a hold of until you can get more sales on the books. But to buy these, I see it so often in this business. And I came out of the grain business, the hedge fund management, trading for profit business. We never hold options for long periods of time. If we do, we're selling stuff all around them to pay that premium back. That time drag, theta, volatility structure, that when the market goes down, volatility goes down. The length you just put on the put is losing money in volatility. It's losing money in time value. And so you're getting less gamma. It's just a really hard proposal. So no, I don't hardly ever recommend long-term puts, especially at these prices. That's a fantastic question. It's something people really need to pay attention to. Just because you own a put doesn't mean you're covered.
Any questions from back here? You guys are all thinking really hard. I see it on your faces. Just spit it out. There are no bad ones. While you've got them here, you might as well ask them.
Yeah, what back here, Matt?
Yes. You look at the production for soybeans, you count double crop beans in that equation?
Question was on soybean production. Do you count double crop beans? Stemming off the wheat acreage situation?
Personally, I do not. Because typically I don't have a lot of double crop beans. One, from an acre standpoint. Two, yields can run from 20 to 50. So they're kind of an unknown. We'll use those as our bonus bushel, typically. Sorry. Start over. Typically, I do not. From the standpoint of the variability of yields and the number of acres don't make that big of a difference as far as the big total production side of it. He may think differently, but, you know, it's hard enough to figure out the full season, let alone the double crop. That makes sense?
So I think that's an answer from the marketing side of it. If you're looking at it from a balance sheet side of it, there's an equation of how they use double crop bean acres. We know not all wheat acres are double crop. I mean, wheat planted in Wisconsin is not generally double cropped on top of, things like that. The few double crop acres that are out there, they are counted at, I'm not sure exactly when they kind of shore up their harvested acres for those numbers and adjust their yield for it, but it is counted in the balance sheets over time. And you mostly, I think, pick it up in the stocks numbers.
Both answers. Thanks, Mark.
Another good question. Anybody else have any? Fire away. See, what's going to happen is we're going to go to break, and you're going to ask like 19 marketing questions when we got these guys sitting right there with a microphone. Yeah, Kurt, go.
All right.
As far as wheat goes, the problems in Ukraine, are they still going to be exporting a large amount? Are they cutting back on wheat as far as pushing the absolutely?
Question was, with Ukraine wheat, as far as wheat goes, will they be counting that, or where does Ukraine stand on wheat, and how's that enter the mix?
Ukraine's a much smaller shipper of wheat than Russia. Russia has roughly 100 million tons of wheat to ship. Russia replacement values, last I saw, were under $5 a bushel, which means if they sell a cargo of wheat at $310 a metric ton, I don't have the math in my head per bushel, but their equivalent replacement is dollars per bushel cheaper than that. So they have an incredible export margin, and they can basically ship wheat at any price if they can get somebody willing to do business with them and buy it. Some of the wheat they're probably trading for oil, missiles, drones, who knows? I mean, it's such a mess over there. But there's a massive supply of wheat there, and Australia just cracked off a huge crop. Brazil, I think, is deficit wheat, so you're going to have some strange flow where you got Australia wheat going into South America. U.S. wheat is competing with corn in July, fob to fob, just because of the basis. But I don't know that we're going to see a big wheat push just from a demand side, because any push in world flat price, Russia's just going to sit there and hammer on. The funds are super short wheat, and so if we close this grain corridor, you could light the wheat market up. And the door's not big enough. The setup is such that if you blow something up geopolitically in wheat, you can create a big bull move. I would be pricing into it if you have known bushels or a comfort level of what you can market. I don't think it's sustainable because the world wheat supply is so large. Crop conditions in the U.S., they're pretty pitiful in the West. So the protein wheat will probably gain on the Chicago wheat, like KC and Minneapolis should gain on Chicago. Soft wheat really has almost no function on the world market. If it gets cheap enough, China would buy it as a corn replacement. I don't think we're there yet. We had this conversation with a couple of us yesterday, and the math doesn't work right now. That you would need something like that to really shift the soft red wheat mentality. And last time we saw that was 13 or 14, where we sold 5 million tons of soft wheat to China. If that's going to happen, it should happen in the next 30, 40 days. I don't think it'll happen. So if you have wheat to move, you get a rally. Don't be lazy with it. You gotta move something.
Mark's got another one. Go ahead, Mark. If wheat blows up, will corn follow?
Yeah, I think you'll get a little bit of a bid there, but the structure of the wheat market versus the corn market is so different. Wheat has a massive fund short. Corn has a pretty large fund long. So it would be a muted response in that regard. And then it just comes to the point, if you pull corn up high enough, does Ukraine find, well, Ukraine is running out of bushels, but does Brazil start selling more cargoes at a discount to U.S.? What does that mean? Higher prices will reduce world demand from these levels. China will reduce their uptake to bare minimum from these levels and stay there until they get to a discount where they can add to their stocks. So, yeah, I think it'd be positive to corn. I don't think it would be an incredible bullish move in corn. I think you just see wheat gain on corn until the funds run out of their position, and then it's kind of like what we had last February and March, we just literally ran out of futures. We had no sellers. And so the market gapped and gapped and gapped. And then all of a sudden, the guy that was buying it, I think I unloaded wheat at $13.90. The guy that was there buying it at $13.90 goes, who am I going to sell this to at a next higher price? All of a sudden, there was nobody home, and it went boom. That's the nature of wheat. It can get thin so quickly.
We got time for one more question. I guess now would be a good time to tell you that obviously the Oglesby table gets to go first for lunch because they did all the heavy lifting, but I probably should have said that to begin with. Any other questions? All right, I'm going to turn it to these guys for closing comments. You know, we're in a meeting developing strategy for 2023. All right, we understand what's in front of us or what we understand about it. With that, launch off of that for closing comments here from a grain marketing standpoint.
It's very easy. I've been doing it for 40 years. Know your costs. None of you in this room sits down and does that. I got 2 that I know of. Margins get thin. You better know if you're making a right decision. It drives everything in your business. Everything. Whether you buy or sell, whatever. Know your costs. Then you can make intelligent decisions. Yes, I know, I get it. Well, I don't know my yield is. Well, he can tell you what your APH is. You got to start somewhere. The year works on, you know what that crop looks like to you. Is it getting any better or any worse? You can up and down the yield year long, and that's going to change your bottom line. It will make you feel better, and it will freeze you. I know how you all think. That yield starts going down, you go into the fetal position. But that is more than times than not your best opportunities. Because it's the uncertainty of the market that gives you the opportunity. Once we peel that onion back so many times, you got a nub. And once you see that nub, party's over. Everybody knows what's going on.
I don't have a whole lot of insight from there. For what we do, we don't predict prices. I can't see geopolitical events. There's no magic ball. It's as much about building a structured position that you can manage risk on. You can define your risk and trying to stay calm when things are not going well. Really staying in neutral mentally is a hard thing to do here. But the best traders I've dealt with and managed with, you don't know if they're winning or losing day in, day out. They generally stay even keeled because they hopefully have built this position, whether it's long this, short this, what have you, in terms of I can manage the risk and I have a plan B. And I think it's really important to do this. And as your costs sneak up on your revenues to where it's almost a break even, what is plan B if this market tanks? What if China says we're going back into trade war? What if Russia says this thing's over, peace is out, and they release 100 million tons of wheat on the market? World coarse grains are just going to get decimated. So there's some problems out there that could really pull the rug out from under a profitable year or marginally profitable year. Does that mean sell everything, stick your head in the sand? No, but know that those risks exist, and trying to catch the high may not be your best approach right now.
Jake, Nate, thank you for being a part of today, and thank you for answering the questions that you did. They're going to mill around here during the break, or they'll be here. You'll be here for the rest of the day, and you'll hear the weather approach. So ask them questions. Obviously, brokerage, grain marketing needs, do talk to them. It's been a program. You guys are familiar with it. They've been around a long time and do a great job, so we appreciate you guys. Thank you for being part of today.